Welcome back to AI Research. Today we are diving deep into the latest economic data from the U.S. Bureau of Economic Analysis, B, to understand the surprising momentum behind the third quarter of 2025. The macro picture. According to the official data, real GDP grew at a robust 4.3% annual rate in Q3 2025. In the world of economics, 2 to 3% is usually considered a healthy, cruising altitude, so 4.3% represents a significant acceleration. To understand why this happened, we have to look at the specific contributions to that growth. Consumer spending, the primary engine, this was the powerhouse of the quarter, adding roughly 2.4 percentage points to the total. The trade balance, exports added nearly 1.0 point, while a decrease in imports added another 0.65 points. Remember, because imports are subtracted from GDP, a decrease actually adds to the final growth number. Government spending provided a modest boost of about 0.4 points. Investment, this was the only drag on the economy, coming in slightly negative at minus 0.02 points, signaling a cooling in business and housing investments. Why did this happen? The underlying causes, while the numbers look great on a chart, the why reveals a complex story of policy shifts and changing consumer habits. Tariff front-running. Much of the boost from lower imports wasn't actually due to lower demand. Instead, businesses flooded the U.S. with goods earlier in the year to beat new tariff deadlines. By Q3, they were simply selling off that existing stock, inventory drawdown, rather than bringing in new shipments. The K-shaped consumer growth was heavily driven by affluent households spending on high-end services, international travel, and tech. We saw a massive spike in information processing equipment, largely fueled by the rapid adoption of AI across the private sector. The One Big Beautiful Bill Act, OBBBA. This July 2025 legislation injected fresh tax incentives into the economy, boosting disposable income just as the quarter began. The housing anchor, the reason investment was negative is largely due to the residential market. High mortgage rates and rising construction costs have kept housing in a slump, acting as a lead weight on an otherwise fast-moving ship. The bottom line, this 4.3% print tells us that the U.S. economy is currently driven by productivity and high-end consumption rather than broad-based hiring. As we look toward 2026, the big question is whether this AI and affluence model can sustain itself if the labor market continues to cool. Alright, this is the AI Research. If you find any value in this, subscribe for more. See you in the next video.